Welcome to UEB Research Spotlight, where we spotlight research making waves worldwide. Article title: The Determinants of Funding Liquidity Risk in Decentralized Lending. Author: Dr. Nguyễn Hong Minh, Nguyễn Ton Bình, Pham Nguyễn An Hoi, Pham T2 TRA. Research objective: this paper analyzes the factors determining funding liquidity risk in decentralized lending, DeFi lending, activities. The study aims to apply traditional financial intermediary theories to the context of DeFi, while empirically testing both internal factors, such as interest rates, users' market power, and deposit concentration, and external factors affecting liquidity risk in DeFi. Research methodology. Data source: high-frequency transactions on the blockchain, with a 5-minute time frame. Study subject: the decentralized lending protocol (AVE), focusing on 5 main liquidity pools: DAI, USDC, USDT, WBTC, and WETH. Approach: a combination of traditional financial theory, CFI, and the unique characteristics of decentralized finance, DeFi, to analyze factors influencing funding liquidity risk. Key findings: current algorithmic interest rate models do not effectively stabilize liquidity as expected, particularly for unstable assets like WBTC and WETH. In the short term, the mechanism of automatically increasing loan interest rates does not encourage borrowers to repay their loans but rather increases liquidity risk. Increasing the decentralization of deposits does not reduce risk and may actually increase liquidity risk. Notable value and academic contribution. This is one of the first studies to examine internal factors influencing funding liquidity risk in DeFi, rather than focusing solely on price volatility or external factors as many previous studies have. The study applies a traditional financial framework, CFI, to decentralized finance, DeFi, highlighting the differences in operational mechanisms and influencing factors. By using high-frequency blockchain data, the research demonstrates the different operation of algorithmic interest rate mechanisms and the risks arising from deposit decentralization, contributing a new academic perspective on risk design and governance in DeFi. Policy recommendations from the study. Since DeFi is an unregulated market and lacks protective mechanisms like deposit insurance or liquidity support, the risk of systemic collapse during a liquidity crisis is significant. Policymakers and the DeFi development community should consider implementing appropriate supervisory mechanisms and encourage the design of protocols that can efficiently self-adjust liquidity to reduce the risk of systemic failure. The study also highlights the need to reassess the concept of absolute decentralization, which has not achieved the expected results and can pose risks if lacking protective mechanisms. Read the full article at